Hey, what's going on, everyone? Christian Carter from Radius Financial Group, and today we are talking about HELOCs, which of course stand for Home Equity Line of Credit. We're going to talk about what a HELOC is, how it works, how they can benefit you, what kind of dangers to look out for when it comes to HELOCs, and then how to actually calculate your monthly mortgage payment when it comes to a HELOC. I'll give you a special hint. There's two different ways. So without further ado, let's get right into the wonderful world of home equity lines of credit, or as I like to say, HELOCs. All right, so what is a HELOC, right? So simply put, a HELOC is a revolving line of credit, right? Meaning the loan balance or the amount of money that you can draw can go up or down as you draw money and as you pay it back, right? So it's a revolving line of credit that's actually tied to the equity in your home, right? And of course, equity, of course, is basically how much money you have in your home. So if your home is worth $400,000 and you owe $200,000 on a mortgage, you have $2,000 worth of equity in your home, right? Another way to think about it is think about a HELOC as like a credit card with a really low interest rate, because the collateral, a credit card doesn't have any collateral, right? So if you don't pay your credit cards, they can go after you, but they can't take your home or take your car or things like that. With a HELOC, the collateral is actually your home, typically your primary residence. So because they have collateral and they can go after your home if you do not pay on the HELOC, that comes with a much lower interest rate, right? So essentially, that's a home equity line of credit, a HELOC, in a nutshell, right? All right, I wanted to head over to the whiteboard to explain a quick thing here, right? Let's say you want to get a home equity line of credit, right? And the lender, which I hope is Radius, says we can lend up to 80% of your home's value, right? 80% loan to value. So you own a home that's worth $400,000, right? We're going to take that $400,000 and we're going to multiply it by 80%, or $400,000 times 0.8, right? That gives us a number of $320,000. So as the lender, that's how high we're willing to go as far as mortgages on your property, right? So we will go to an 80% loan to value. Now, you already owe $200,000 on a first mortgage on that property, right? So essentially what we do is we take the $320,000 that we can go up to, we can lend up to, because that's 80% of 400. We subtract your current mortgage amount, which is $200,000, and then we get a remainder of $120,000. So for this example, if a lender is willing to give you a home equity line of credit up to 80% loan to value, the home is worth $400,000. You still owe $200,000 on the property. We can give you a home equity line of credit for up to $120,000. I hope that helps. All right, so next up here, what can you use a home equity line of credit? What can you use it for, right? You can use it for just about anything. Typical things that people use it for are home renovations. So if you're planning on doing a new kitchen, adding a bathroom, adding another bedroom, adding another addition to your home, those are some really common uses for a home equity line of credit. Also, two other common uses: student tuition. So paying for a child to go to college, right? Paying their tuition out of a HELOC, or possibly consolidating some high interest debt, such as credit cards or personal loans or things like that. You can consolidate that debt by using a HELOC, a home equity line of credit. Those are some great uses for a home equity line of credit. However, you can also use it, and I definitely do not advise this, but you can use it to go on vacation. You can use it to live off of. You can use it to buy expensive toys like jet skis or ATVs or things like that. Again, I would highly discourage you from using a home equity line of credit for that. But essentially, again, it's just like a credit card. You can use it for however you'd like. All right, now I want to go over something that's very important, right? When it comes to a HELOC, we basically have two periods of the HELOC, right? We have a draw period, and then we have a repayment period. The draw period comes first, and just like it sounds, that's when you're drawing money from that account in order to pay for whatever you want. And that draw period is typically the first 10 years of the loan. And during this time, the interest rate is usually floating, meaning the interest rate could go up or it could go down. It floats with the market. So that's the first 10 years is the draw period, when you're drawing out money to pay for whatever you want, new addition, college tuition, blah, blah, blah. After that first 10 years, you then go into the repayment period, right? Now, the repayment period is typically 10 to 20 years after that first 10-year draw period, usually 20 years. And most times, 9 times out of 10, you're going to lock the interest rate during the beginning of the repayment period because you're going to start repaying the loan, right? Pretty simple. Draw period, repayment period. Now, how do we figure out our monthly payment when it comes to the draw period and when it comes to the repayment period? Good question, because we're going to go over it right now. So, let's say you have a loan balance right now on your HELOC of $100,000. And let's say the interest rate today, because again, this thing is floating with the market, could go up or down, but the interest rate today is at 8%. What we're going to do is we're going to take that loan balance of $100,000. We're going to multiply it by 8%, right? Which of course is $100,000 times 0.08. And we get an annual interest amount of $8,000. So that's how much money we would owe in a year. In order to get our monthly payment breakdown though, we're going to take that $8,000 divided by 12. So our monthly payment, again, remember that this is interest only because we're not paying the loan back during this draw period unless you want to. But our monthly payment on this $100,000 HELOC would be $666.66. I hope that made sense. Now let's go to the repayment period, right? So you've used this HELOC for 10 years, paid for college for the kids, put a new addition on the house, everything is great. The 10 years is over. Now it's time to fully repay back the loan, right? So for our example, we're going to keep the loan balance of $100,000, keep the interest rate of 8%, and we're going to have a 20-year repayment period, right? So as you can see, the monthly payment on the repayment period has now gone up to $836.44, the monthly payment. And that's because you're no longer just paying interest on that $100,000 balance. You're now paying the principal back, the loan amount back through monthly payments. I hope that makes sense. Now, if you're wondering how I got that monthly payment, that fully amortizing monthly payment, I just used this really simple calculation over here. Or you can just use a mortgage calculator, which is much easier. This is like some Goodwill Hunting stuff. All right, so let's talk about some benefits and let's talk about some risks that are associated with a HELOC, right? So first off the bat, let's talk about some benefits. Number one, the HELOCs come at a much lower interest rate than a personal loan or a credit card, right? We're talking about a much, much lower interest rate. Another benefit of a home equity line of credit is the flexibility, right? You can use that home equity line of credit pretty much however you want. If you want to pay off credit card debt, if you like I said, want to put on an addition to your house, you can do so. Also, you only pay interest or payments on the money that you take out, meaning you could apply for a home equity line of credit and not ever draw money from it for the next, let's say, 5 years. You would never pay any sort of payment for the next 5 years because you're not drawing on any of that money, right? Now, let's talk about some risks as well. Number one risk is and people get into trouble with home equity lines of credit, is that they don't realize that this home equity line of credit is tied to your home, right? So your primary residence typically is going to be the collateral for this home equity line of credit. Meaning, if even if you keep paying your regular monthly mortgage payments every single month on time and in full, if you don't pay your HELOC payments, they could potentially foreclose on you and take your home. So that's by far the biggest risk associated with a home equity line of credit. All right, that is all she wrote on the wonderful world of HELOCs, home equity lines of credit. If you like this video, I would really, really love it if you can give me a big thumbs up down there. Also, if you tend to like a majority of my videos, I would love it if you could subscribe to my channel. That really, really helps me out. And then last and most important, if you want me to cover another topic, please leave it in the comments below. I will make sure to shoot a video. And other than that, I hope everyone's doing well. Have a great day. Talk to you later.